So let's consider this example. Ivar's aeronautic manufacturing. Um, so they provided 6-month return windows on all the fabricated, manufactured aeronautical equipment sales. The company has sold all equipment for a decade, right? So they have experience. And the returns follow a predictable seasonal pattern based on a percent of sales revenue. So we can, right? This is not the case. We don't have to wait for the expiration of the return window. We can record revenue as we make sales, even though the right of return exists. The company established that 3% based on these historic sales will be returned within a 6-month window. It recorded $100 million of sales revenue during 20X5. During the year, returned $2.4 million of sales, and there's a gross profit percent of 55%. If the company began the year with an outstanding refund liability of $700,000, record the entries for the returns during the period, any required entry at the end of the year. So in this case, we have a refund liability of $700,000. So that guy is sitting out here at a $700,000 credit balance. That means that when these returns are coming in during the year, the first 700,000 of those returns is going to be debited against this amount. Because at the end of the prior year, at the end of 20X4, we established this as the refund liability amount for the sales that were potentially still outstanding that hadn't been returned yet. So when the returns are made, so these are the sales returns during the period, we would record this as a debit to the refund liability. For all of it, zero it out. The way I think of it is, hey, we just tagged, the sales that were from the prior period, the ones we expected. So now this is debited and we get that zeroed out. But we still have more returns. And again, assume cash. It doesn't really matter because remember the total amount of returns that occurred were $2.4 million of sales. So that's the amount of cash we got back. If it was a credit sale, it'd be accounts receivable. But again, we don't worry. Just it's either a credit to cash or a credit to receivable. The remaining amount, right, because we have a discrepancy here, is the sales returns and allowances. So what we're doing in effect with this journal entry, let me go ahead and finish it out, is tagging returns, right? Well, 700,000 is not being recognized as sales returns and allowances this period in 20X5. Why? Because when this refund liability was created, it was the end of the prior year. It was the end of the prior year when we debited sales returns and allowances 700,000, credited the refund liability 700,000 to have this as our beginning balance at 1/1X5. So this are those returns from the prior year. We matched the income effect during that prior year because we recognized the revenue from those sales in the prior year. So there's no more net income effect here for those 700,000. These, on the other hand, based on our estimate, must be sales that are being returned from this year based on our estimate. So we do want to match that income reduction against the sales revenues re-recorded in 20x5. Okay. So really think that through. Don't just like put in your head, oh, I zero this first and then I go here. Understand why some of this is being recognized as an income effect and the rest of it is not being recognized as an income effect this year, but was recognized in the prior year as an income effect. Okay. So this is the entry for those $2.4 million of returns. We would, because we have a gross profit percent, we would want to recognize how much inventory and cost of goods sold change because of this. But I do want to wait on that to talk about that in class, kind of as a extra piece to sales returns. Um, I do want to talk about what would be recognized at the end of the period. So this is going to be our adjusting entry. The adjusting entry here would be equal to what did we expect to have returned based on the sales we made this year, but was not returned, right? So think of it this way. We take the $100 million of sales revenue. We have a 3% expectation, right? $100 million of sales revenue times the 3% expectation of having returns. So we expect $3 million of sales to be returned based on our sales this period. How many sales during this period have been returned based on our estimate? The answer comes from this entry. We have not had $2.4 million of sales returns from sales this period. This is a combination of sales made in the prior period, the 700,000, and sales made this period, the 1.7 million. So we have only recognized 1.7 million from this period sales, which means we still have $1.3 million of sales we expect to come back as returns just from the sales made this period, right? 3 million are expected in total. Only 1.7 million were counted as a reduction to matched appropriately. We still have 1.3 million to match as outstanding returns. And so we debit sales returns and allowances by 1.3 million. And then we credit the refund liability by 1.3 million. Of course, this reduces net income and this increases my liability. Okay. One item that I just realized was an error is when I updated these notes, I made a foible with the inventory cost of goods sold pieces. And we will talk about this in class, and I will make sure that my error is understood. So when we're doing the adjustment for the sales that did not happen at the end of the period, we actually want to debit inventory estimated, right? Because this isn't back yet. This is not a physical item that we've gotten back. So we do want to append estimated with a hyphen to the end of this inventory. It's not physically in our location yet. We do want to credit cost of goods sold, right? We do want to credit cost of goods sold. And why do we want to do that? Because we're reducing our sales returns and allowances by a total revenue amount, right? It's being taken against when we record something to this account, it is being subtracted off of sales revenue to give me net sales. So I am subtracting the full price here, but I get a bit of an abatement because of this cost of goods sold that was not really sold because it was returned. So we do want to credit cost of goods sold in the period of the adjustment. This changes something a little bit up here where the goods are then actually returned in the next period, right? I said, hey, we have some of this coming back in. We need to reduce or rebate a little bit of our cost of goods sold re-recorded when we made that sale. When in the next period it actually comes in, I can't credit COGS again. I would be double crediting COGS. I'm actually going to credit inventory estimated because it's no longer an estimation that this inventory is coming in. It's a fact. So I get rid of that estimated inventory account and then I actually debit inventory. And I'll do an example in class to really kind of make sure you see it all. And I apologize for that discrepancy. Right, we will apply it to this one so that you can see the full piece, and I will cover questions about this in class as well.